Hi, it's producer Sasha jumping in here just to remind you that Superhero does not provide financial advice that considers your personal objectives, financial situation, or particular needs. All investments carry risk, so please consider carefully before investing. Past performance is not indicative of future performance. That's it from me. Enjoy the show.
Equity Mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going?
I'm very good, Bryce. Very excited for this interview. We're loving the opportunity to speak to some of the biggest and best CEOs from Australia and around the world. And we've got a CEO who we've had on the show before, but he just keeps building and building. So we thought we had to get him back to talk about the company that has really come from nothing to something that probably everyone in the Equity Mates community knows about in just a couple of years.
That's right. It is our pleasure to welcome back John Winters from Superhero. John, welcome.
Thanks, guys. Thanks for the intro. Well, it hasn't even been a couple of years yet. It's not even been one. So, yeah,
wow.
It's pretty exciting. I think it's
there
like
you go.
9 or something, yeah.
So for those of you who haven't come across John before, he's the co-founder and CEO of Superhero, an online broker offering Australians the lowest cost access to the Aussie market and now the US stock market as well, which we will dig into. Before co-founding Superhero, John was a stockbroker and private wealth manager at Shaw and Partners and Macquarie. So plenty of experience, but we're interested in the entrepreneurship side and what you're building, John. So we're going to focus on that aspect in this interview today.
John, we always like to start these CEO series by hearing the company leader describe their company in their own words. Now, for people who haven't heard our previous interview or seen a bus, tram or train in Australia in the last 6 months, can you tell us what Superhero is in your own words?
Yeah, sure. So just a bit of background. So yeah, I've been in stockbroking, wealth management for about the last 15 years, and really saw some of the issues in that industry and how hard it was for people who wanted to start investing. So that's what drove the birth of Superhero. And to give you a quick overview of what we are, I'll give you the sort of the extended elevator pitch. We are an online investment platform. We deal in Aussie and now US shares, and we're really trying to make investing accessible to everyone. So it's often been very hard to even get started investing. So knowing where to go, knowing even how to set up an account before you've bought any shares, or when you're looking to make your first investment, what to actually invest in. So we want to bridge that gap. We're trying to make it accessible, understandable, and of course affordable for everyone in Australia.
So there's plenty of players in the broker space now, and it feels like almost every month there's a new player coming to town. So it's certainly becoming crowded here. Why, I guess, try and enter this market? What is it that Superhero does differently, or how do you try and differentiate yourself between what seems like a pretty crowded market at the moment? Yeah,
so we launched in September last year, and so it has been a pretty short journey so far. But when we look back at September, when we launched to the Aussie market, there were the big banks. Then there were a couple of other smaller second tier broking houses, online trading firms, and we felt like none of them were really solving the problem in the market. So you've got the big banks that are charging at least $20 a trade. There's a couple of others around that are doing slightly less than that. But it really looked like, in terms of a user experience, it was sort of a spreadsheet that had migrated onto a website that had been iterated over time. So it really didn't take this tech-first millennial sort of user experience that we've seen in so many other markets, whether it's watching TV, whether it's getting a car to the airport or something. We hadn't seen that level of user experience brought into the investment world in Australia. So we've been trying to bridge that gap. That's one of sort of the key differences that we saw in the market. But over the last few months, we have seen a lot of competition come into the space. I do feel like people are doing it as a bit of we're going to try and dabble in this and we'll see how it goes. They're not super focused on a single mission. So yeah, there are a whole bunch of people coming out that you can buy US shares or you can trade Aussie shares. But I think it's that key point of difference. This is what we live and breathe every day. We are the cheapest, which is a pretty proud thing to say. Like, we are the cheapest in Australia. When it comes to Aussie share trading, flat $5 for Aussie shares. Aussie ETFs, zero brokerage to buy. No one else is doing that. That's pretty cool achievement. Pat myself on the back. But when we look at US, like the world has, it's been a race to the bottom when it comes to fees, and the US is at zero. And that's the expectation, particularly on the US market. So we've been able to bring zero to market as well. But what's important is we've got one of the lowest FX transfer rates, and we can get into that a little bit more. But transferring funds from Aussie dollars to US dollars is obviously a critical component. So we allow you to do that at a very low cost, but also in real time, which no one else has really done. So it's always been 3 to 5 days. You fund your account, so you're waiting a few days until you get your cash before you can invest. You could be sitting at home on a Thursday night watching the AFL and see our ad on TV, sign up for an account, put money in your account, transfer it into US dollars, and buy Apple in about 3 minutes before the US market opens for the night. So yeah, which I think is pretty cool.
Yeah, it is pretty incredible. And I mean, you launched in September and the growth journey has been pretty incredible as well. From a feature point of view, US trading, you've reduced the cost, $0 ETFs, but also just in terms of the growth of the business. We remember the last time we spoke, you're in a smaller office, and now we can see your background in a much bigger, shinier office. We'd love to hear that story, what it's been like scaling the business, scaling the team, scaling the infrastructure to keep up with that pretty incredible growth rate. Looking
back at last year, which was a pretty big roller coaster year for, I'd say, everyone globally. I think it was middle of the year we had 6 employees, which was up from 3 in sort of March, April. So we sort of doubled to 6. In September when we launched, I think we had about 10. And we moved office in September, the same month we launched. We moved office because we ran out of space. In December we had 19, and in Feb we had to move office again because we ran out of space. We've got 35 people in the business now. The office we moved into in Feb, I don't know, we're either growing too quickly or we can't plan very well. We've now run out of space again. We're thankfully there's more space in the building, so we're going to move to a bigger floor. But yeah, just in terms of headcount, it's been a pretty wild journey, and one of the big parts of building a business is keeping culture, the team culture alive, and it's a pretty proud thing to say that everyone loves coming to work every day, and that's not me saying it, that's other people. We'll sit in on interviews, and people will ask about culture, and people who work for Superhero say, "Oh, John, I'll answer this one," and they say, we love coming to work. It's an awesome place to work. We're so pretty proud of that. So yeah, in terms of scaling, staff is obviously a massive piece. But then when we look at all of there's so many parts to that. There's all the systems. When you place a trade and your trade goes through, you get a text message. We're spending hundreds of thousands of text messages every month. So you think about all the flow-on effects that we're having, whether it's our servers, whether it's text messages, whether it's emails. There's hundreds of thousands and millions of different communications going out every month, and we kind of haven't really scratched the surface yet. So yeah, it's pretty interesting to see that. But when it comes to our customers, that's where it gets really exciting. So we're creeping up towards 100,000 people on the platform now, which is just phenomenal. When we started live testing in August last year, there were 5 or 6 of us, and we did 3 trades in a day. We're like, yeah, 3 trades. Yesterday was only 2, and now there's thousands a day. So yeah, seeing so many people jump on board, the adoption rate is it's real sort of pinch me moment when we look back at it. But also just, standing around the office, I said to Wayne, my co-founder, I was like, look how many people there are. Like, look at all the people here. It's crazy. There's so many people, and they love it and live and breathe, the brand, and they're serving our customers every day, with a whole heart. So yeah, it's pretty exciting.
I've got a couple of questions on people and culture that I want to touch on in a little bit, but let's turn our attention to the US trading side of things. So you have just announced the big platform update. US shares are now available. Yeah. Do you know, we spoke to one of the major Australian exchanges and they weren't as confident that many Australians were actually interested in investing in the US or actually doing that, particularly with a millennial focus.
Yeah.
On your side of things, from your, customers, do you know how many people are investing in US shares at the moment?
There wouldn't be any bias in that major Australian exchange suggesting that, would there? Look, it's a good question. We actually did some research recently, and it said about 17% of Aussies are currently invested in overseas investments. So, which includes US shares. I think the thing about US, if we just look at US shares in particular, the barriers to entry have been so high for so long. So when I was a stockbroker, setting up a US account was a nightmare. The fees were exorbitant. To be able to transfer shares in and out was just hard. FX was hard, and particularly in the broker or the advice space, a lot of advisors will not give advice on US shares. So you naturally just default back to Aussie. And if you look at the split of Aussie versus US equities in a typical portfolio, in a typical advised portfolio, it's about 80-20 as a general rule. And the 20% is typically brought about by international ETFs and things. And that's just because there's a barrier gap, like a barrier of entry, but also a knowledge gap at the advisor level that flows down to the individual customer. So when we look at the market, I think we've got 2,500 Aussie shares and ETFs on the platform. We just added 4,500. So now there's 7,000 different investment opportunities. You sort of get decision paralysis. Like the first night that we signed that we had it going, I put some money in and I was like, okay, well, look, what do I invest in? Like, what's the first
S&P 500?
You've sort of got the top ones, which are the favourites on our platform and sort of in the market. You've got Apple, you've got Tesla, you've got Amazon, Alphabet. You've got sort of the FANG stocks, which are the sort of the go-to. But outside of those, there's a lot of household brands, but people don't really think of those as an investment opportunity. Like, is Nike a good investment? Is Nvidia a good? So there is a knowledge gap on that space, but I think that is, and we're working on that as well, is if we can close that knowledge gap, people will be much more informed, and I think there'll be higher demand. But certainly in the early stages, the interest and the use of US on our platform, it's been pretty overwhelming.
Mm.
Yeah, this might be a bit of a softball question because Bryce and I, we are strong believers in international investing, but I'm going to ask you it anyway because we love the opportunity to invest outside Australia. But why would an investor think beyond the ASX? Why would they want to invest in the US?
Why would they? I think when you look at the Aussie market, it's pretty small. Like, Apple as a market cap is bigger than our entire market here.
That's crazy.
It's the entire ASX. So I think when you look at the opportunity particularly in the US, and some people say, oh, what about this market? What about that market? I think if you want global exposure, you can pretty much get everything you need on the US market. So whether it's going into the Chinese, tech majors, most of them are listed in the States. I think that looking abroad gives people so much more choice. It gives you exposure to so much more. We do have a very small market here. And while there's great companies, you've got the big banks that pay dividends, you've got, the big mining stocks, but we don't have a huge tech exposure, like global tech exposure. there's so much in retail that we just don't have exposure to. You know, you think of some of the luxury brands that are going off in China. You know, you want to sort of jump on board. You know, here we've got Kogan and Temple & Webster. What about all of these other luxury brands and things that you can invest in the States? So not to say Kogan and Temple & Webster are bad investment decisions, but it's just opening up the opportunities to so much more that we don't have purely through the ASX.
So we've obviously seen the outcome of what you've done. You now offer US trading on the platform, but we love to hear the inside story. We're here to talk about, you know, entrepreneurship and you as leading the company through the process. So what was the process like, I guess, engaging Aussie regulators, the regulators in the US, and actually getting the 4,500 stocks on? Because, correct me if I'm wrong, but there are also plenty more stocks available in the States. So how did you come to actually getting this going?
Yeah, so I guess the Aussie regulation piece is a really important one. We are regulated by ASIC, and we have to meet, you know, all of the rules and regulations here in Australia. When we look to the US, I think one of the key things around the number of shares that we offer is not so much a regulatory side of it's not a regulatory matter. It's more of a availability and tech question. So the 4,500 shares that we offer fractional investing on, and not all stocks in the States allow fractional. So you know, if you wanted to buy Apple, it's, you know, $145, correct me, right? Thereabouts, something around there, right? So if you wanted to invest $100, you could buy $100 worth of Apple. So you buy a fraction of a share. But there's some, you know, Amazon is, you know, in the 3,000s. If you wanted to buy $100 worth of Amazon, you could. Where there's some stocks that don't allow fractional, so you'd only be able to buy one unit. So if we turned that on, we'd be able to offer significantly more. A lot of those securities are low price securities. They're you know, the pink sheets that, you know, we've heard about in movies and things, which do come with additional risk from a regulatory point of view. They come with additional cost as well, and, you know, some of those are over the counter. So they're more sort of tricky to manage through a platform. And what we see is we really see demand for, you know, the top 5 to 10 stocks in the S&P 500 rather than the real sort of tail end of companies.
Do you offer fractional ownership of Berkshire Hathaway Class A?
No, we don't. So that's a good example, right? So that's not a fractional stock. It's Class B, that is. So which I think is about $290 or $300. So you could buy a fractional portion of that. But you got to stump up the 450 grand or whatever it is for the Class A's. Yeah.
It's the price of a house to buy one Class A share.
I know, it's crazy.
Keep saving.
You've obviously, you know, you've got US trading now. You've had ASX going for about 9 months. You've got a treasure trove of data on how, like, what Aussies are buying, what they're selling, both here and in the US. So would love to, I guess, get some insight for us and the Equity Mates listeners. So maybe if we start at the top, what have been some of the most bought stocks in Australia and the US? What's really popular right now?
I reckon we could name all 10.
Do you reckon you could?
I reckon
you could as well. Yeah, they're not quite meme stocks in Australia, but certainly.
Do you have GameStop on your platform?
For US, yeah, we do.
Yeah. Oh, there you go.
I bought $100 worth just to dip the toe. I was like, oh, cool, I've got to have some.
Nice.
And AMC. But yeah, looking at the Aussies, Zip has been the number one standout from the beginning. You know, I think it just really resonates with people. And Afterpay is a close second. So these are the guys that have built such a massive sort of customer following. It's almost like these cult followings that they've built. So people use their payment products every day, and it's flowed through into the market as well. You know, they've built massive customer bases both in Australia and globally, and their share price has been on the tear pretty much since when they listed. So yeah, Zip and Afterpay would probably be the two most bought stocks since we started. Brainchip has been a big one as well. And then looking at some of the sort of the bigger cap, Flight Centre, Qantas, Fortescue have been sort of some of the other bigger cap.
Okay.
And even recently, like Flight Centre and Qantas have been pretty popular, which is interesting given the lockdowns in pretty much every state in the last few weeks and months.
Probably shows that long-term investing message is getting through, which is
I think people are aware that things don't last forever. So what we saw in March last year with the market tanking, and even what we saw during the GFC, like the markets bounced back pretty quickly. So I think people are sort of buying the dip when it comes to those guys. When we look at ETFs. And if you look sort of broadly, it is tech that people want exposure to. It's just staunchly tech. So Asia Tech is very popular. So BetaShares Asia Tech Tigers ETF has been the number one ETF bought on the platform. That gives you exposure to JD.com, to Alibaba, to Tencent, some of the big, which are still household names. Like everyone seems to know, may not know what their business model is, but you've probably heard the name before. And that has been a great performer, even recently with some of the volatility in some of those underlying names. Aussie Share, the Vanguard Aussie Shares Index, and NASDAQ and the NASDAQ 100 NDQ, they've also been standouts. And what's been really interesting is some of the investor behavior is people are coming on and they typically buy Asia, NDQ, and VAS, the Vanguard Aussie Share Index ETF, as their core kind of portfolio. So they're setting up this like global core of the biggest Aussie shares and tech names that there are, and then they're sort of supplementing that with a bit of Zip, bit of Afterpay, bit of few others as sort of their higher growth opportunities.
Well, it's good to know that everyone's been listening to Equity Mates then, because that's exactly what we talk about on the show. Going global. Going global, setting up your core, playing around with a bit of a satellite approach. So, there's no doubt we've done a lot of content recently on Asia as well, so I'm not surprised that you're seeing that reflected through the trades that are being made.
So basically, Bryce is just trying to claim credit for everything that you built.
Yeah.
Now, Bryce has said he reckons you can pick the top traded US shares, so I think we should put him on the spot before you tell us.
I mentioned them earlier, so let's see if he's got a good memory as well. Let's see. Go on.
Has he been listening? That's an even better question. What do you reckon it's been, Bryce?
Oh, so we can't go past Apple, Amazon,
No, just top one, mate.
Oh, top one for US, it would be it'd be Apple.
Yep, standout.
Is he right?
Yeah, Amazon's in the top 10, but it's pretty far down the list. It is early days.
Really?
But yeah, Apple is the sort of the go-to. Tesla is as number 2, which is an interesting one. There's a lot of demand for ESG investing and certainly on the electrification theme. It's sort of when you think of how do you invest in electric cars and the sort of the future of electric cars? Yeah, I pretty much ask anyone. They'll go, Tesla, and they'd be stumped for a second opinion. So yeah, Tesla's number 2, closely after Apple.
Usually the second is some obscure lithium miner in Western Australia.
Well, AC/DC is one of the top ETFs on the Aussie market. And, while it's battery tech, the biggest holdings in that is Aussie lithium miners. So there's a whole bunch of Aussie lithium miners in there.
Is there any other sort of surprising data that's starting to flow through from what you're seeing on your end? We're also hearing a lot about the inflation the potential for inflation at the moment. Are you seeing sort of any superheroes investing on that trend, or is it just tech Asia? Let's do it.
We saw the whole inflation trade sort of grip the market mid-June, and the market pulled back a fair bit. But it didn't last. It didn't last very long. We sort of bounced back, and the market's back at its highs. So I don't think the inflation sort of trade is really a running theme. We did see over those few days, a higher amount of net buying into some of the bigger names like CBA, Fortescue, you know, some of the big blue chips. But yeah, it's really, people just want to invest. We always say that invest in what you're invested in. And you've got an iPhone, you kind of get Apple. You know, everyone knows the brand. You're invested emotionally in their brand if you use one of their products. Same with Amazon, same with Afterpay, same with Zip. So it just happens that some of the biggest consumer brands in the world are tech focused. So yeah, people particularly our age, they do want exposure to that, and they've been awesome performers over years.
So talking about investing in what you're invested in, if that's the case, then Australians are very invested in the buy now, pay later sector, given that they're the two most popular in Australia. Opening up US shares means you open up maybe not a whole lot more buy now, pay later companies, but a few. PayPal is obviously US listed, and also Affirm, the US buy now, pay later competitor to Afterpay and Zip. Are Aussie investors jumping on the US buy now, pay later stocks as well?
PayPal's on the list. I haven't seen Affirm. I think the Affirm business model is a little bit different. They actually started at a similar time to Zip and Afterpay in the States. I think in the early days they actually had the same sort of brand colours as well to Zip. So it was an interesting one. But they do have a different business model. They listed with a lot of fanfare and then pulled back pretty hard. I think when you look at buy now, pay later though, globally, there's Affirm would certainly be up there in the US, but you've got Klarna as the big unlisted one. You've got Afterpay, QuadPay in the States, which is owned by Zip, and then Affirm. So yeah, there's probably four there. PayPal has made a lot of noise about going into the space. They haven't really made a dent yet, but they do have a massive footprint with all the merchants and a huge amount of customers. So it'll be interesting to see how that plays out. So yeah, they're on the list, but I think when you think of buy now, pay later and the leaders, it's sort of Zip and Afterpay, whether you're in the States, in the UK or in Australia.
You love to see that from Australia, really punching above our weight.
So America, the US have the FANG stocks. The Aussies have the WAX stocks, Afterpay of which we've spoken about enough and is very popular. But what are you seeing on your end in terms of the WiseTechs, the Appen, the Xero, all pretty good tech companies, great stories here in Australia, but not necessarily as popular as tech stocks, I guess. Is that kind of coming through on your end?
Yeah, I think that the thing about the WAX stocks is they're not all consumer-driven companies. So you don't have that sort of consumer affiliation to it, like WiseTech. How many of us use WiseTech on a daily basis? Right, that's sort of like that, and I think that's the key thing. Like, I think there's a certain amount of sexiness to these consumer tech stocks. Everyone wants the latest iPhone. You want the latest tech. You want the latest product. You want, and you want to pay it off over time. So yeah, I think that's what's missing from some of those B2B players. So they do have. I think the one exception to that is probably Xero. Like they've built an unbelievable customer base. Their growth has been massive over a long period of time. But yeah, the real B2B guys, I think they are sort of missing that B2C, flair.
Well, Bryce keeps saying he wants to get into training AI and machine learning algorithms, so we might use Appen one day. but until then, until he learns to code, I can say that. So another key focus of the Equity Mates community, and I imagine Superhero users, is climate change investing, ESG, and sustainability. We've seen BetaShares and VanEck come out with new products recently in the ETF space. Are they popular? And I guess is ESG investing generally popular from the superhero community?
It is, and I think it's a growing trend. People want to be able to invest with a clear conscience, and there's definitely a growing way to do that. So some of the ethical investing ETFs, green energy, even some of the sort of the ethical adjacent names like AC/DC, the battery tech ones, like these are all very popular on the platform. But it's quite interesting when you scratch beneath the surface. People I think, they're sort of attracted to the ethical name, but a lot of people wouldn't understand what the actual underlying businesses are. So if you look at, say, the BetaShares Global Sustainability ETF, you look at the list, it's actually the list of the biggest US tech stocks. Which is pretty interesting because it's those guys who are making a lot of headway when it comes to using clean energy to power their data centers, and using a whole range of different approaches when it comes to running their businesses in a sustainable way, corporate governance, and ESG investing is not just about planting trees and keeping carbon emissions low. There's a whole range of different factors that go into it. So there's definitely a rising trend. When we look at ACDC as an ETF that I mentioned earlier, it's battery tech. So it's going into the electrification theme, going into electric cars. But a whole bunch of those underlying investments are lithium miners. So it's a really interesting sort of concept when people are thinking about ethical investing. What does that actually mean, and what does it mean to you? I think that's an interesting one to look at. But there's certainly a lot of demand and rising demand across the platform and across the industry.
It's a question that we're always trying to answer on Equity Mates is what does ESG mean, because it's so different to every person, really. Like, you could look at Apple and think that it's one of the most unethical companies in the world, or you could look at it and think it's doing absolutely everything possible to be an ESG company.
And like Fortescue wants to go to zero emissions.
Yeah.
But they're digging dirt out of the ground, which is quite an interesting one. Like, how do you sort of deal with that if you're looking for a really ethical investment and you're sort of...
This is the issue. You're a conundrum.
Yeah, it's the conundrum. Yeah.
Well, I think the best example of that is Tesla, who most people would associate it with everything good about sustainability and move to electric vehicles. But BetaShares just took them out of their global ethical fund.
Well, at the end of the day, the cars are made of metal that's dug out of the ground. The batteries are made of lithium that's dug out of the ground. And there's a bunch of copper in it. There's all of this stuff. So yeah, it's a really clean vehicle in terms of emissions from the vehicle. But what carbon emissions went into sort of building the car? So yeah, it is a conundrum that I don't think is easily answered.
But I think that's the good thing about learning to invest yourself is you can make those decisions yourself rather than relying on someone else to make them for you. And I think with US trading, you now have a whole other world of companies to choose from, and some of the biggest solar companies and renewable energy utilities and all of these companies that are working on these big problems are listed in the US. So it just massively opens up your universe in terms of the companies you can look at and the choices you have.
So, John, I do want to touch on people and culture. We always have this type of discussion when we're chatting to CEOs and founders. You mentioned at the start that you've gone from 3 employees in April last year to mismanaging office sizes multiple times and now landing with 36, and I'm sure it's just going to continue to grow. In that space of time, you've gone from having to actually manage and lead 3 people who I imagine would have probably been co-founders as well, and now to a much bigger team. How are you thinking about like your leadership style? Do you have a leadership philosophy? Because I imagine, you probably didn't start out at the beginning with a clearly defined leadership method.
Yeah, it's challenging. It's like having a really big family, really big family, big. And you've got to give everyone equal love and attention. So yeah, it is challenging. I wouldn't change it for the world. Like, everyone in the team is awesome and just fits their niche in the business. Everyone just does their part. I guess my sort of management style is, I love people to sort of pick up the reins and go, to run their own race. And thankfully everyone is, we're all in the canoe and we're all rowing in the same direction, which Wayne and I are incredibly proud of. There's obviously speed bumps along the way. There's 35 different personalities in the business. So it's it's tough to manage and to match people in teams and things. But as we grow, we have had to, and it's hard to delegate as well, because you go from having just a handful of people, and you sort of should it be that blue or that blue, and what size text, and should it be on that line or that line, like the real minutiae in the weeds. To having to let go of some of that stuff, it is hard. To having to let go of some of the the operational side of things, and have a direct report that's reporting in, basically just reporting in issues. So we hope to have limited communication on in some respects, but it's hard to sort of delegate those key functions that are core to the business that I sort of started out doing. But what we've seen is everyone's just sort of, we're all moving in the same direction. Everyone comes to work in their superhero t-shirt every day, and wears it on the weekend as well. Like, they just love it. So yeah, it's
just like Ren and his equity mates.
Yeah. So yeah, I kind of feel like if I'm not wearing my superhero kit to work, I kind of feel like it's like going to school without your uniform on. You sort of like the old one out. You feel a bit naked. So yeah, but it's in terms of the team, it's incredibly powerful to see everyone just like band together and execute with a single vision.
And just one more, like where I'm doing this purely from a selfish point of view, but we're going through the process of building our team at Equity Mates, and I'm always fascinated in how you think about hiring, because at such a infant stage of a business, every single hire is incredibly important. If you have 5,000 people in an organization, it's not as drastic as hiring your fifth person. So how do you think about that process and make sure that you're getting the best?
Yeah, so the first thing's culture. So you have to be a good fit on a cultural front. You can be the best designer, the best developer, the best compliance person, the best customer service person. But if you don't fit the culture of the business, it's going to be damaging to everyone else. So that's the first thing that we do. So every interview that we do at Superhero is a culture interview. It's usually 10, 15 minutes. It's a hi, how you doing? Where are you at the moment? Where do you see yourself in the future? Just to get a bit of an understanding of who you are, just like have a chat. And once we sort of, and you can pick up people's sort of attitude pretty quickly. So we have a rule that culture interview is first, and just get to know each other a little bit before we move on to technical skills or past experience and stuff. So yeah, I'd certainly, if you're asking for advice, I'd certainly say look at culture being the key. Have a bad egg and it can really spoil things.
I guess we'll do ours at the pub then.
Perfect.
But Bryce wants our culture just to be drinking.
No, but that's the thing, right? You have a beer with someone and you get to know who they are.
So John, whenever we do these CEO series interviews, we like to finish with the same final three questions, just on the future of the business. But before we do, I guess we want to remind everyone, Superhero now has US stocks, so they should, if they're not already signed up, they should go and check that out. More than doubled the investable universe with the click of a button.
Zero brokerage as well.
Fractional shares. Competitive FX. What more can you ask for? Maybe European shares. Yeah, I'm just going to put that on the table.
You sort of go back to that. And you're like, what can't you get exposure to through the US and the Aussie market? Yeah, no, I know. Yeah, no, I know. I get that, but it's like the small little Italian bank that's in part of Florence, it's listed on the main exchange in Italy. I just think,
hey, there are some pretty big companies in Europe.
Totally, but I guess what's the demand? If we're seeing out of 4,500 US stocks, we're seeing 60 to 70% going into one name. There's definitely demand for everything. It's does the demand sort of, is there a meaningful sort of business behind it to make it worthwhile?
Well, everyone go to John's Twitter, flood his DMs if you are demanding that. Do not come to Bryce and I. But John, we'll get into these final 3 questions. So the first one is, what do the next 12 months look like for Superhero as a business? Is there anything in the product pipeline, anything you're particularly excited about that you can announce on Equity Mates?
Yeah, so I think we're pretty young in the market, so we've just sort of started out over the last 9 months or so. So I think building up that Aussie footprint is key. That's our sort of core business. We've just added in US shares, which is a massive addition, and we see it as there's other companies out there that have US just as their single product. That is their business. We've got the two plugged together in one user interface, so you sort of hold one portfolio now and have as many companies in it as you want across both markets. So definitely scaling that up, continuing to build out the user interface with further enhancements. We really want it to be a place where you can come and start your investment journey or continue it. So if you're an experienced investor, you probably have an idea of what you want to invest in, but there's a lot of people out there who don't know where to start, who don't know what to invest in, and we want to make that a much easier process for them to identify opportunities in a meaningful way, but not a complex way. So it's got to be understandable. So I think that's going to be our core focus. We did start Superhero for a single purpose, and that was superannuation. So we do have some exciting news coming up about that. It has been in the media a little bit. So we do have super launching as well, which is pretty exciting. And we should have another chat about that.
We should have another chat about that. Now, there's a lot of things to obviously celebrate at Superhero at the moment, and congratulations. But when you look at your business, what is the biggest risk you're facing at the moment?
Yeah, so the biggest risk, I think it goes back to the people side of things. The biggest risk is certainly in our people. They are what make us. And it's really hard in the current environment. It's really hard to find good people. At the same time, we've got to keep good people as well. And thankfully, the team that we've got love being here. I think the other thing is, being Wayne and I as the founders. There's like key man risk. So Wayne, I couldn't do this without my co-founder. Hopefully he says the same thing about me. But yeah, I think there's just, there's a huge amount of understanding between us, when it comes to the business model, when it comes to the product, when it comes to the vision. To replace that, I would say would be near impossible. So yeah, I reckon it's pretty strongly the people would be the risk point.
We should pause for a moment and give Wayne a shout out. We interviewed him in our summer series, so people can scroll back in the feed and check that out. Not only is he the co-founder and CTO at Superhero, but he's also the deputy CEO and CTO at Booktopia. So not busy at all, Wayne.
He's got 2 full-time jobs. I still don't know how he does it.
He's good. He must be good, though. Yeah. Or he really half-asses both of them and he just gets away with it. But John, look, you've only been live for 9 months, but you're obviously thinking long-term with the business. You're encouraging long-term investors. If you think 10 years from now and what Superhero could be, what does success look like for you?
Geez, 10 years is a long time. I don't even know what I'm having for dinner tonight. 10 years time, let's think about it. I think we want to continue delivering on what we've started out delivering on. We want to build an environment for people to grow their wealth, and whether that is direct shares, whether that's managing portfolios, whether that's giving people the ability to invest in unknown Italian banks in the European market. Whether it's additional markets,
Nice.
whether it's new geographies, whether it's new products. I think we just want to grow the business, but really with the customer at the center of it all, just making sure that they can build their wealth. I think our business model is fortunate that we can provide a very low cost product to our customers while still having a sustainable business, and not many people can say that. So we're pretty proud of that, and I think it's doing more of what we've already done, just at a bigger scale, to make sure that all of our customers have a meaningful experience over the long term.
Well, there's no doubt that you certainly are making markets more accessible for Aussie investors. So congrats. The competition's only getting stronger here in Australia, which is great for us on the consumer side. But we love seeing the journey and looking forward to seeing how Superhero grows over the next 10 years. So as always, John, appreciate your time, and we look forward to having that chat about Super
For sure.
at some
Thanks,
point.
guys. Thanks for the support.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.